Good afternoon, and welcome to our webinar series, Tedstrom Talks. This is the 14th in a series of webinars that we are producing to give our clients, business associates, friends, and family pertinent and important information on COVID-19 and interesting and timely topics. Your video and microphones have been muted. However, please feel free to use the Q&A icon and the chat icon located at the bottom of your screen to ask questions throughout the presentation. I would like to introduce you to Peter Tedstrom, founder and chief advisor of Tedstrom Wealth Advisors. Peter has 36 plus years of experience as a certified financial planner. He has been consistently recognized through awards and recognition as one of the country's top financial advisors. Peter, go ahead and take it away.
Thank you, Barbie, and welcome everybody. Our 14th webinar. It's amazing. Since we've been in isolation, if you will, and since the big original COVID scare, March 15th, I've been in the office just a couple times. And this really has been a great way for us to reach out to our clients and our friends, our business associates, and keep them informed about things other than just the market and investments. And today is much like that. We've got Liz Deveau. She's a CFP. She's responsible for iShares distribution across Four Corners region, partnering with financial advisors to provide ETF insights and education, as well as advanced factors and fixed income ETF expertise. Prior to joining BlackRock in 2009, Liz worked for Nuveen Investments in Chicago, supporting their mutual fund, their separately managed account, and closed-end fund business. Additionally, as a financial advisor for a Citi family office team in Chicago and a derivatives trader in Chicago and London. Liz attended Duke University, where she majored in public policy, markets and management, and played on the Duke women's soccer team. That's fantastic. She also holds the CFP, or Certified Financial Planner designation. And today, Liz, it's an interesting day for to talk about innovation and inventions. Today is Tesla Battery Day. Many of you probably don't know that, and I didn't know that until yesterday, that Elon Musk is supposedly going to make an announcement about a new battery that's going to be far bigger and better and much more power and longer lasting than anything we've had available up until now. And obviously, with electric cars being the new trend or wave or rage, if you will, a longer lasting battery will certainly catch my interest when I'm buying another car, or my next car, probably electric. So Liz, in today's day and age, when we're so down and the media is telling us that the economy will never come back, and that we're not going to get jobs back, and companies are going to go out of business, which is certainly true. We're losing businesses, and companies are going away. Yet things are happening behind the scenes, aren't they? Where new things are happening, solving problems around COVID and other issues that our country deals with. And I'm astounded by our history. We have created a system of entrepreneurs and capitalists that create an environment where these inventions and new ideas can take hold, and people can solve major problems and get wealthy as a result. So Liz, tell us about these inventions and innovations.
I was just trying to catch up quickly on what the Battery Day means. His latest tweet was, "Many exciting things will be unveiled," with a lightning bolt emoji. So stay tuned. Let me go ahead and share my screen. So yes, to Peter's point, I mean, this is an exciting time and I think importantly, thinking and considering a long-term perspective, right? We've seen very, very quickly many key themes and innovations come to this market and to this economy with force and acceleration because of COVID. But there is a lot to be sort of optimistic about and opportunistic about. And so that's really the narrative here. So like indicated, I cover our ETFs for BlackRock. I'm a BlackRock employee. I've been here about 11 or 12 years. And I work with financial advisors and their clients to understand our financial products and investment solutions, the markets, build portfolios, and ultimately help leverage the best of what BlackRock has. And I am excited about this presentation specifically because there is a lot to feel positive about despite our environment amidst this pandemic. So a couple of things kind of to set the stage. The world is changing quickly, rapidly, evolving at the speed of innovation. And a couple of examples here. A billion hours ago, humanity emerged. A billion seconds ago, IBM released its first PC, and a billion Google searches ago was just this morning. Our economy and society are driven forward by mega trends, by structural shifts in the way we live and work today. And so we're going to discuss these forces and how they can drive investment returns, enhance returns, and also enhance our sense of purpose as the world evolves around us. So these structural trends are different from cyclical themes. So it's important to sort of distinguish the difference between these two. So cyclical trends are short-term by nature, maybe weeks, maybe months, but driven by a very discrete catalyst. And so an example would be, something that changes in the healthcare sector because of legislation, or maybe something around the election. So these sort of trends rise as quickly as they fall, and that means timing them can be very tricky, very challenging, but critical, right, to get this play right. Structural trends are long-term by nature. They take many years to play out, and so the entry point is less important. They're often driven by societal shifts in regulation, technological advancements, economic advancements as well. And so think of structural shifts like the automobile or the television or internet, these big, powerful forces that at the time felt almost inevitable. And so over a number of years, they delivered significant returns for investors who took the right approach. So again, the entry point is less important. The trick is trying to keep your eyes open and just be aware of what feels inevitable around us. And so I think the Tesla example is a good example, right? Like, we are seeing more and more EVs on the road. That is something that feels obvious to us, but buying Tesla may not be exactly the right way to play it. You might want to buy across the value chain as an example. So today's presentation is about the future and some ideas from BlackRock on how to capture the future. So before we get into that, though, let's sort of look back and take a look back at some of the innovations of the 20th century. One common form, if we go back to the turn of the century, of transportation was the horse and buggy. So our roads, our cities, they were built to accommodate this form of transportation, of transit. But very quickly, the automobile came into our market. And so you fast forward, amazingly, in 25 years' time, that horse and buggy, which was everyone's form of transportation, was essentially a novelty, extinct by 1930s, falling 93%. Now, if you were an investor at that time, as the automobile came about, and you started to see these cars for the first time, imagine, you would have seen the potential for this to change everything. But how you actually go about investing in it is the challenge. And so how did you find the companies that actually prosper? If you go back to the turn of the century, the early 1900s, there were about 1,000 auto manufacturers. And so the vast majority did not survive, and sifting through all of those bad investments to find the Ford, the GM, the Michelin, the Goodyear that built the world's infrastructure for cars, that was the challenge, even though you could feel that trend happening around you. Similarly, fast forward to the end of World War II, when the GIs came home, the television was just sort of getting legs. And there was about one television in every 10,000 households in the US. 12 years later, it's basically everywhere. 4 out of 5 American households had a television. So just in 12 years, the television took over. But again, actioning that in an investment was difficult. You could certainly invest in the TV manufacturers, but some of the biggest players and the biggest benefactors were companies like NBC, ABC, CBS, the advertisers that brought those national brands to reach millions of Americans, and those national brands that leveraged that medium. So again, the trend was powerful, easy to spot, but the investment implications were pretty complex and spread across that whole ecosystem. So 25 years for the automobile to displace the horse and buggy, 12 years for the television to reach everyone, essentially. And then more recently, think about Facebook. It took 4 years for Facebook to have 100 million users. And I think about the depths of the pandemic. I've got 2 little girls. I live over in Littleton, and they're 5 and 7. And for us, 2 working parents, kids at home, the depths of the pandemic, Disney Plus was a savior. And Disney Plus went on to subscribe like 50 million people or households in just a few weeks. So the speed of innovation, the increasing speed of technology means that even long-term structural trends today are playing out within very investable timeframes. So the challenge is, again, like how do you execute on that idea, on that theme? And so this is what we call the Goldilocks problem, and you'll understand what I mean in a moment. But the issue is that the trends of tomorrow may feel easy to spot, but investing them has historically been trickier. And I think about FANG. FANG is a term that is thrown around in the media. Many of you are probably familiar with it, but it stands for some of the best performing, most well-known innovative firms of the last 20 years. So Facebook owns the social platform. Amazon is absolutely the e-commerce giant. Apple is the smartphone. Netflix is streaming. And Google, of course, is search. So all of us, I'm sure, wishes that we had jumped on the bandwagon with one of these companies, and maybe you did. Maybe you got that pick right. But looking back, it wasn't absolutely obvious. And this is an example. So I think back and cast your mind back to the 90s for a minute. And this chart actually starts about the time I graduated from high school, from Green Mountain High School, May of '99. And so we're showing you here 2 e-commerce companies during 1999, the performance of Company A and Company B. Both, e-commerce companies, one absolutely the stock market darling of the year, and one of them, decent returns up 22%. That's pretty good, but not necessarily the 200 plus. One was the seller of toys over the internet, and one was the seller of books. And so you can probably see where this is going. Company A was eToys, if you remember that company. They went bankrupt pretty quickly after that first slide in '99 when they were the darling of e-commerce. And then Amazon went on to return 34 times return if you fast forward to today. So looking at it, picking that winner there was not obvious. It was not easy. Even though, our collective wisdom of the markets, and we recognize that, the e-commerce trend was very easy to spot, executing on it and picking the winner was difficult. Now, sometimes though, investing in a broad market may be not quite as precise as you would hope. And so you could buy the single stock and risk losing it all. You could buy the broad market and maybe not quite get what you're looking for in terms of a precise execution. Or perhaps there's somewhere in the middle. And so that's where we try to find these megatrend indexes that have a more focused exposure, but don't make it the investor susceptible to what we call idiosyncratic risk or single stock risk. So the single stock, of course, lacks diversification. The broad tech index maybe isn't quite capturing the e-commerce trend that you're looking for. There's got to be a sweet spot right in the middle. So how do you spot the trend? I mean, like I mentioned in the earlier points, it really is all around you. So an example here is self-driving cars. And so, we're not promising that self-driving cars are going to, be a huge mega trend, but we like this space a lot. And I think it's pretty obvious that they're cool, right? We all recognize that self-driving cars are cool. We probably believe that there will be more of them in the years to come. Will your grandkids, your children ever learn to drive? I mean, I think that's debatable. I'm not actually sure mine ever will. We shall see. But that really is something to be excited about. You don't have to be a futurist to spot that. That's probably a trend that will continue and has some legs. We use a quote from Ferris Bueller, which is a movie I haven't seen in a very long time, but Ferris Bueller said, life moves pretty fast. If you don't stop and look around once in a while, you could miss that. So, we started with the comments around the rise of the automobile replacing the horse and buggy. I just referenced the potential for self-driving cars being an exciting trend that we probably believe we'll see more of. But we're living right now through this explosion of electric vehicles. And so one of the reasons that this is so exciting is that we see more of them on the road month after month. And we're seeing that because there are structural forces at play. So megatrend opportunities tend to have some commonalities. They tend to have regulatory, societal, and economic forces at play. And so first, if we stick with the EV theme, the electrical vehicle theme, let's hit on regulatory. So on the supply side of electric vehicles, and this is a global theme, by the way, this is a global secular trend. On the supply side, we see, especially in Europe, as an example, some of our largest automobile makers, take Volkswagen for example, European governments are mandating lower emissions. And so that means companies like Volkswagen have to take the average emissions on their vehicles down massively in the coming years. And so the only way to accomplish that is to invest in electric vehicles. So we're seeing that happening on the supply side. On the demand side, I think this is really interesting. Beijing, as an example, the Chinese government there is now requiring that in order to buy a gas-powered vehicle, you have to actually win a lottery. So you enter a lottery system. If your name is drawn, you're allowed to buy a gas-powered vehicle. Well, that very quickly reversed the trend towards gas-powered vehicles because there's no such requirement for EVs. So electrical vehicles, within a year of that decision for the Chinese government to do that, China became the #1 electric vehicle market in the world. So supply and demand, regulatory forces at play here. On the societal side, more and more cities around the world, Tesla or its equivalent in whatever country is a status symbol. And so not just in the way like a Cadillac or maybe a Range Rover feels these days, but Teslas, they're nice cars, of course, they're beautiful, but it's also about the premium that people are willing to pay, because when you're in a Tesla, it declares that you're green. And so it's also about that branding. And so even if you don't fall into this camp where you care about being branded as a green driver, you can't deny the fact that most of our younger consumers are leaning that way. So consumers aged 18 to 34, they're willing to pay a premium to drive a cleaner vehicle. And then the third point is around economic. And Peter, you hit on this earlier, right? The cost of batteries and their lifespan is really what's driving whether or not we're jumping on that bandwagon. So for one, the cost of electric vehicle batteries has continued to drop, and maybe we'll hear something more from Elon today on this, but from over $1,200 or roughly $1,200 about 8 years ago to, I read this morning, more like $150. And so that economic tailwinds in the cost to produce electrical vehicles, combined with, let's say, a longer lifespan, of course, on how long it stays charged, that's really starting to drive the economic tailwinds there too. So the point is, all three of these, the confluence of regulatory, societal, and economic tailwinds, when those come together, that really dictates a megatrend. So we have a couple that we've identified from BlackRock. We have 5 different swim lanes, so to speak. And I'd say, technology, we have on the left side of your slide here, that is its own swim lane, pure play tech. But then I would say technology sort of coexists across all 5 of these themes. Within tech breakthrough, think of like cybersecurity or robotics and AI, that sort of falls into that bucket. The second one here is demographics and social change. The world is aging, and we see, especially in the US, a change from more grandparents to grandchildren in the next 10 years. So more people over the age of 65 than under 18 for, I believe, the first time ever. And so what does that lead to? Well, that leads to more investing in healthcare, in medical breakthroughs, in research and development. So that is our second megatrend. Urbanization, this one's been debated recently, and maybe you feel this in your community, where we have believed in the rapid urbanization, city dwellers migrating to cities. COVID has, of course, pushed some folks out of these cities, the big cities like New York and San Francisco, in favor of more suburban living, but not necessarily rural living. But when we're talking about rapid urbanization, broaden your scope to think about emerging markets and middle-class consumers for the first time coming online and wanting to come into the cities. We're talking about these rapid mega cities basically building themselves up from scratch. So most of the rapid urbanization theme is really related to the emerging market countries. Climate change is here, resource scarcity. This is a mega trend that is about not necessarily just screaming out fossil fuels, let's say, or green companies, but it's about innovation and clean energy. Electric vehicles falls into this one too. And then the final one is about emerging global wealth. So emerging global wealth is on the rise for middle-class consumers. And so in places like China and India, there are many, many millions of people that have disposable income for the first time. That's what we're talking about, emerging global wealth. So these are our 5 swim lanes, the 5 fast rivers, and then in each of them are individual investment themes. But let me pause there because I can't quite see the question box. Are there any questions, Barbie or Peter, before I move on?
You know, I don't see any, Liz, but I want to remind the audience that if you click on Q&A or chat, which is down below your screen, and if you have a question, feel free to put it there, and Liz will answer it for us.
Okay, excellent. So let's move on, and we're going to go into each of these themes. So tech breakthrough. You know, as I mentioned, tech is across all 5 of these themes, but we're talking specifically about places like cybersecurity, AI, exponential technology. But here's an exercise, and this is about consumer preferences. So we have a little polling here, and think about if you would give up your cell phone or dessert for a week, which one would you sacrifice? And then think about, okay, if I had to give up my cell phone or my alcoholic beverage of choice for a week, which one would I sacrifice? The vast majority of people are happy to give up alcohol for their cell phone, and about 50-50 on dessert, which I actually found that surprising. But the point here is the preference to maintain their connectivity through their cell phone. It's very important that we keep track of our own priorities and preferences and the preferences of those around us to spot these mega trends. And I think about the Internet of Things, and COVID has essentially been a beta test for the rise of the Internet of Things, Internet connected devices. And in my own home, I mentioned I have 2 little girls. Instead of bringing home homework, my 7-year-old is bringing home her Chromebook. And so for the first time, she has an internet connected device. Many of my colleagues, BlackRock is a very much heavily coastal. We have a big presence in Manhattan and a big presence in San Francisco. Most of those colleagues' children are still teleeducated, so they are all new Internet of Things consumers, those young children. And then telemedicine is another example where, you know, intriguing pre-COVID, and I certainly dabbled in that. I didn't feel like going to a pediatrician with my child to diagnose an ear infection that I knew was clearly an ear infection. I was using telemedicine, but today it's the obvious preference, the obvious convenience is to see your doctor in the comfort of your home, right? And so you see a lot of this happening more and more. My family, we actually just moved. We are one of the folks that was looking for more space, more square footage post-COVID. And now I'm a cord cutter. So we moved into this new home. We don't even have cable any longer. We only have internet TV. And so that's 4 new internet connected devices in our home we continue to evolve towards this internet of connected devices. So here we are sitting at about 30 billion internet connected devices right now. Quickly in 5 years, we'll be twice that, even more at 75 billion. But with that comes, of course, the need for more data protection and cyber protection. So in 6 years, roughly, back in 2014, there was only 1 cyber criminal on the FBI's most wanted list. And today that number is 71 and rising. So on one hand, you know, that's a little bit scary. But on the other hand, the growing threat of cybersecurity creates investment opportunities because it means we're putting more and more resources into fighting back. And so, you know, I just started this discussion with, you know, pointing out that investing in megatrends is more about just enhancing returns. It can also be about purpose. And many of us care very deeply about data privacy, about the data privacy of our children, of our family. And so an investment in cybersecurity is a way not only to capture returns, but to help fund those firms that are at the cutting edge of a safer cyber tomorrow. Now, this brings me to my first mega rule, and I will interrupt this tour of our 5 mega trends with a couple of these rules. And so the first one, and we hear a lot about this right now because many of these FANG companies have been driving outsized returns for the broad market. And so we're seeing more and more concentration in clients' portfolios in those FANG companies. This becomes more and more relevant, but think back to 2000, and what we're showing here are the top companies in the S&P 500. So back in 2000, Microsoft, GE, Cisco, Walmart, Intel, right? Fast forward 20 years, Microsoft is the only name remaining. Think forward 20 years, who will be there in 20 years from now? And in fact, I just looked earlier, I think Berkshire Hathaway has fallen out of the top 5 in favor of Google. But the point is to weight your portfolios for tomorrow and avoid getting highly concentrated in those top companies of today. Be more opportunistic and look at some of the smaller companies. And so that's where BlackRock has come in to try to solve for that through our megatrend ETFs in particular. So let's pivot to demographics and social change. So this was my point earlier, that the world is getting older, and I don't mean the people, or I don't mean the planet, I mean the people. More grandparents soon in the US than grandchildren. I heard someone recently internally say that there were more adult diapers sold in Japan than kids' diapers. So the world is aging, and the point is there is more spending going towards healthcare. So in the US, we'll be spending $2 trillion more on healthcare than we did just a few years ago. And so what that means is that there will be, there will be more spending on research and development, on solving for some of these diseases, on solving through medical breakthroughs to extend lives, to protect against cancer, et cetera. And 2 areas that we're particularly excited about, even before COVID, and even enhanced by COVID, is these 2 subsectors or sub-themes within healthcare, genomics and immunology. So genomics is the study of how do we cater medical treatment to an individual's own genome. And it seems not that long ago that we were able to map the first genome back in 2003, and it cost $1 billion to do that. Today, it's under $700. So $1 billion to map it back in 2003, and now under $700. So this means that it is economically feasible to now cater your medical treatment to your own personalized genome. That's genomics. So having tailored medicine, personalized medicine. The second one is immunotherapy, and this has been primarily about revolutionizing cancer treatments. But today we're talking about how do we stimulate the body's immune system to fight COVID, not just cancer, but to fight COVID. And so you see a lot of conversations right now around the COVID-19 vaccine, and it's almost that the coronavirus has accelerated progress in this space. And so we're seeing now, convalescent plasma being used to replicate, taking that from survivors of COVID-19 to replicate and scale production to treat others more broadly. And that's immunology. So as with cybersecurity, where there's a little bit of a purpose-driven element here, these themes present the opportunity to be part of the solution to some of society's greatest challenges. So 2 here with genomics and immunology. The next theme is rapid urbanization. And I mentioned earlier that, in my conversations with advisors, I hear more and more people doubt this one just based on what we're seeing from COVID real estate buying. But 70% of this trend is about the emerging world. And so here's a map of some of those cities that had population growth planning, the biggest population growth through 2030. And so you see in places like Cairo, 50 million new people, Shanghai, 7 million new people. I mean, these are emerging cities, emerging mega cities. And so while we do see this trend, this COVID trend from cities like New York and San Francisco, where people are moving to, in the case of New York, they're moving to Connecticut or New Jersey, but they're still part of those suburban metros, and those suburban metros still do need improved and modernized infrastructure. Many of these other cities on this map are more like they're starting from scratch. So this is something we get excited about, and the point here is investing in these mega cities and this urbanization trend through infrastructure spending. In many cases, these new cities that are starting from scratch, especially in Asia, it actually, you can capture all 5 mega trends in one. And so, you know, these mega cities need data centers, they need Wi-Fi, they need AI enabled CCTVs and 5G. And so that's what we mean by the mega city concept and the rapid urbanization. The next one is climate change and resource scarcity. So again, we're talking about the firms that are on the cutting edge of green, clean technology and innovation. We're not talking about just screaming away fossil fuels here. We're talking about owning innovators in this space. And I think this is really important. And we talked about how it was those the combination of those important forces, regulatory being one. So here's an example of regulatory powers driving this theme. So here we have the renewable targets for various regions across the globe. And you can see there's over $1 trillion that Asia, countries in Asia are setting aside to reach their renewable targets. There are now about 90 countries that have renewable energy spending targets. And US here being the lowest, but think about, you know, and maybe this is why our clean energy ETF has had the flows. I think it's our top flow driver this year. The clean energy ETF, you know, part of that is the idea that 16 billion from the US is kind of low in comparison to some of these other regions. And if we do see a Biden win, if we do see the Green New Deal, that will definitely up our spending towards these renewable targets. So you combine, you know, this regulatory force with the societal preferences for cleaner energy and also rapidly falling production costs relative to fossil fuels, and you get all of these forces coming into one megatrend. The second rule, very relevant to today's battery day, yet again, is connect the value chain. So when you think about these megatrends, think about it through the lens, as an example, think about it through the lens of electric vehicles. So as of last year, there are about 2 million of them on the road. And by 2040, the projections are more than 60 million electric vehicles here in the US. And we talked earlier about the combustion engine replacing the horse and buggy. At the time, there were 1,000 promising car companies, with only a few emerging as winners. You know, you want to be careful to load off on just one name. And so similar to where the benefactors of that car revolution were tire companies in some cases, were the fuel providers. It wasn't just those that made the car. Well, EVs are similar. So this could mean investing, in places like Tesla, but also in BYD, which is the Tesla of China and sells more cars than Tesla. Also means investing in the makers of batteries and the miners of lithium, the makers of charging stations and the infrastructure around supporting that. So investing across the value chain, not just in one particular company, and avoiding that single stock risk. The final megatrend from BlackRock is the concept of this emerging global wealth. And so what we mean here is the rise of the middle class consumer in Asia in particular. So a couple stats here on the left-hand side, I think this is pretty interesting. China mints 2 billionaires per week. 2 billionaires a week are coming out of China. 90% of those entering the middle class every year are in Asia. And so that's 150 million people. 90% of them are coming from Asia. And then really staggering to think about is 44 people escape extreme poverty in India every minute. Every minute, 44 people are coming out of poverty. And so if you think about what that means for innovation for the world of tomorrow, these countries are building their cities, their payment systems, their data networks for the first time ever. And so they don't have to refresh or modernize existing infrastructure. They're starting from scratch. So you see some of these Chinese cities, as an example, they don't even have cash. Like their whole city is built on Alipay or other local apps. And so in this growing wealth and opportunity, they're starting from scratch. These are the hotbeds of megatrend innovation and adoption, so they really can't be ignored. And that brings us to our final mega rule, which is think beyond borders. Megatrends, you know, there are no borders with megatrends. There's no geography involved here. The internet adoption in China is a really good example. So not only does China have many more people than the US, they have, I think, 4 times the number of citizens in China than in the US, but only half of those Chinese citizens have access to the internet. Think about that. Like, think about the potential as these folks come online and as they start having more discretionary income. The numbers in India are even more staggering in terms of those that are less connected, even than China. So if we think about, you know, our portfolios today, and we study a lot of portfolios at BlackRock, our advisors and clients' portfolios have a very strong home country bias. And that's natural. And, you know, we buy what we know, what we're comfortable with. But as we've moved, you know, as we've deglobalized, or as the COVID has sort of required us to rethink supply chains, to deglobalize, there's actually more diversification benefits from thinking beyond borders. So that even enhances this mega rule. Okay, I'm going to wrap up with a couple points. We're at about half hour, and then maybe we can take some questions. But, you know, again, these are our big swim lanes, our 5 megatrends, and then the sub-themes underlying each of them. And it's a lot to be excited about. It's a lot to think positively about. I mean, owning the future, in spite of everything we feel during this pandemic, there are opportunities out there. But I believe it's really important for you to recognize that the biggest determinants of your success as an investor are, 1, your behavior, controlling your behavior, working with your advisor to hold you accountable for good investing behavior, and then your asset allocation. These are all critical components, and they work together. So at BlackRock, you know, reaching your long-term goals really depends. We believe it depends on your behavior, your partnership with your advisor, and your asset allocation and proper portfolio construction. And we hope that some of these themes can help sort of advance the opportunities to reach those goals. So the final point is around the mega rules. So consider waiting for tomorrow. Build each mega trend fund, or build your portfolio without over allocating to those big established tech names, and think about the next 20 years. 20 years from now, who will be those big companies? You know, not just FANG portfolios, not just FANG stocks. The second point is connect the value chain. Don't load up on a single stock, and don't get too broad, but find, you know, the component parts across that value chain and buy the ecosystem of your theme and those firms that are positioned to benefit from that theme. And then think beyond borders. So don't just limit yourself to the US, but don't let that hold you back, and realize the potential of companies that could be positioned across the globe and around the world. The future is coming at us faster and faster. COVID is only accelerating some of these mega trends. And so we hope that will help you get there first. Thank you very much. I've spoken for about half an hour straight, so I'm happy to take some questions. Maybe we can open it up.
Absolutely. Thank you, Liz. And we do have time for questions. There's a question here from Benjamin. What about investing in Africa? It seems like there's a lot of opportunity in that continent with natural resources and an emerging middle class.
It's a good point. I mean, it hasn't come. I see your point on the commodities. What was it? Commodities and agriculture. Is that what Benjamin said?
Natural resources and an emerging middle
natural resources. Yeah, I don't think you're off. BlackRock doesn't feel as strongly about that emerging middle class as we do for for India and China. The challenge with some of those African countries is they are so heavily dominated by those natural resources that it ends up being a commodity play. So even if you buy an ETF that is specific to a country in Africa, you end up really loading up on one sector or another. And so I think, you know, we're getting more diverse sector exposure through some of those other countries I mentioned. It's a great question, and I'd be happy to follow up with Peter after and see if I can dig a little bit further into BlackRock's perspective there, but it doesn't fall into our mega trends. Though I would say, commodities and resources have certainly been a trend this year because we are seeing more and more emphasis on preparing portfolios for rising inflation. And so we at BlackRock like real assets. So we like the idea of not only owning Treasury inflation protected bonds, but thinking about how does real estate play into my picture? How do commodities exposures play in? And will that help bring more resilience in inflationary environments? The Fed has basically told us they want to let run hot for the next few years.
Interesting. I actually had a conversation with one of the individuals that's on our webinar and observing, and I said, you got to listen to this. One question that came up was gold, and I invested clients' money in gold 30 years ago, and that was probably the last time because it's just so streaky and it gets attention when it's hitting highs and nobody thinks about it when it's hitting lows, but of course that's when we should be buying an investment. What are your thoughts about gold going forward, Liz?
So I think the hard part about gold is there's no yield, right? So it's hard to own some of these collectibles without a carry, as we call it, without some sort of yield that helps to sort of cushion and build wealth over time. Small portfolio allocations to collectibles, to metals can help can help insulate portfolios in an inflationary environment, but can also, of course, dampen volatility if we do see an aggressive pullback in the stock market. So we don't have a strong buy on gold, but we do believe in it as a strategic asset allocation element and a portfolio diversifier. But it's not something that we're, particularly bullish on, especially at this level. I think, what is it? Is it almost to 2,000?
Yeah, I think it recently hit an all-time high. Yeah. We have a question from James. He says, referencing recent pending legislation targeting foreign companies for accounting fraud and delisting if they don't agree to same level of transparency required by US and European countries. Foreign companies are often opaque. Any tips on how to find better names?
Any tips on how to, so the question is, how do I sift through and find quality companies in European countries? That sounds like the question.
Yeah, that might not be at risk for accounting fraud or delisting.
Yeah, so I would say avoid a single stock, a single European stock. If that is in fact the case, that there's accounting fraud and potential to delist, I'd say if you believe in developed European companies, as actually BlackRock does, we recently went overweight, especially on cyclicals. And cyclicals are companies that are, not defensive, not sort of company like toilet paper, right? Like not something you need every day, but something that you want to spend your discretionary income on. We think that they're in the early innings of the stimulus really flowing through their economy. So we like developed European, but I would say buy that in a diversified basket. Don't spend your time sifting through accounting fraud, research. I would say do that in a scaled, diversified way.
Okay. And our clients, our investors know that we advocate diversification as one of the more important tenets when we're helping them put their portfolios together. And really, all of this is so exciting, and it's a reminder to all of you out there that what we don't see is sometimes the most important thing to be aware of. That what we see is what the media presents to us, and we're feeling down and out, and we're discouraged, and companies are going out of business. But so much is happening that we don't see that can change our lives, and can change it pretty quickly with the internet adapting over 4 years. What's going to be next? Is the new thing going to take 2 years or a year for us to fully embrace? What are your thoughts on the traditional energy sector based on some of the megatrends you've mentioned today?
Yeah. So in one sense, it's kind of a value play, right? Because we obviously oil is trading where it is. It's what, $40 on a barrel, something like that. So that's an attractive narrative. But I do believe, and when I say BlackRock does believe that the forces behind the clean energy movement and investing towards renewables, that really positions more green technology. But that doesn't mean to shy away from energy companies entirely. In fact, many of those companies are reinventing themselves to be more environmentally friendly, to embrace renewables. So BlackRock, we don't feel opportunistic or optimistic on it right now because we don't feel a strong catalyst for traditional energy, but I wouldn't say to exclude it entirely. I think there is some value to be had there. We just don't feel the same passion around the structural forces behind it. Is that helpful?
I think so, and it actually brings up a thought around oil and how many people are moving away from the use of oil because of the carbon footprint and climate issues. I know that we've added an ESG position to our portfolio, environmental social governance. Tell us about that as it relates to innovation. Are they related?
It's a great question. So BlackRock feels, first of all, BlackRock feels very strongly in providing investors with choice. And so we're a huge index franchise, we're a huge active franchise, and we are a technology company. In the places where we have control of assets, so where we have discretionary control, and that's in our active and alternative business, we've decided to step away from thermal coal. We don't like the regulatory risks. We don't like the environmental impact. So where we have discretion, we have taken steps to minimize. On the index side, we have taken steps to allow clients access to choice. And so, yeah, you can buy the market cap weighted index that has fossil fuels, or you can buy one that reweights the index towards more sustainable outcomes, which I think is what you're referring to. Or you can buy something that's totally exclusionary and doesn't hold any fossil fuels. That middle point is where we've seen the most substantial and surprising flows this year is investors and advisors from all walks of life recognizing, okay, this is an underpriced risk. Sustainable risk is something that it's another lens on alpha. It's another lens on how to discover companies that are well positioned for the future. And so we've seen outsized flows into our sustainable lineup this year. I'm excited about that. And I feel like, and I know it's been proven out that you're not giving up return. You're not increasing risk to achieve more sustainable outcomes. It's kind of a no-brainer. So I feel like I've gone down this path. So BlackRock, where we can control, we will eliminate some of that thermal coal, which is like the most dirty, environmentally unfriendly companies. We provide more choice. Our clients like it and they want it, and they're evolving towards that. So that's sort of where we stand on ESG.
Excellent, thank you. And Carrie says,
there's one more question. Carrie says, you mentioned cities in China that are starting with no cash. How do you think we will become cashless in the US?
Oof, I love that question. And it's so funny because I think about like my Dunkin' Donuts who stopped dealing with coins, right? They just, in the middle of COVID, they said, well, we don't accept cash. We don't have any cash to give you. You have to use Apple Pay. And it's almost like COVID and the coin shortage has accelerated this trend more and more. I don't know that we become cashless in the US. I think there's a narrative there that is, logical though, especially if we think about those millennials, of which I am like the oldest millennial you will meet. Millennials want to transact that way. And if they are becoming the biggest earners of our society, and if they are the biggest working population now, and that's their preference, I don't see why we wouldn't become cashless in the next 20, 40 years. But I don't think I don't think there's urgency right now. Is that helpful?
Yeah, I think that in general, many of us use a lot more credit than we use cash today, but it's still nice to have a 20 or 50 in the pocket for something, maybe a tip or something like that.
Yeah.
Well, thank you.
I think
Liz.
I want to hold. Yeah, good. Sorry.
I really appreciate your time. And I was thinking about your question, which really presented a conundrum, I suspect, for others as well. Dessert, cell phone. Well, my answer would be it depends upon the dessert. If it's creme brulee, I might give up the cell phone for a week. So again, thank you very much, Liz. If anybody has any follow-up questions for Liz that they'd like to address at some point, let us know. Send an email, call us. Liz, I'm sure, would be happy to interact with some additional responses if there are other questions. Thank you, everybody. Have a great afternoon. Bye-bye.